Just gonna let it roll.
Welcome back to the show with my esteemed guest once again, Mr. Josh Lewis, certified mortgage professional consultant. Everything finance, mortgage related, all of that good stuff. We're going to start the show as we always do, answering your real estate and mortgage related questions. But before we do that, we're going to dive into the most recent news, which is really inflation, right? Last Wednesday, we were on the show. We were talking about headline inflation, core inflation likely dropping, but we got it wrong when we said we didn't really know if it was going to impact rates. And in turn, with the inflation numbers dropping, the mortgage rates improved considerably, dropping anywhere between 0.5% and 0.75%. And the market has kind of stayed there, which is really nice to see, Josh. So, maybe a little bit of update on the inflation data. We're going to dive into some charts. We're going to answer some questions. And we're also having another guest on the show, Shaheedah Hill, who's out of Georgia, another YouTuber. A lot of you guys watch her. We're going to see what's going on in that Atlanta, Georgia market. And again, answer your questions and help guide you guys through the path of home ownership. So Josh, welcome to the show.
Well, I'm glad we overcame our technical difficulties and we're able to hear me. Yeah,
that is the question. I cannot hear Josh, but that does not mean that I am right.
If you can hear me, throw it up in the comments. It's showing on my end. The mic is working.
But Jeb's not able to hear me. Letting us know if they can hear Josh. No one is commenting. No one's commenting. I can hear you both. Well, that's great, Josh, because I can't hear you. So I'm not sure how we're going to have a show when I can't actually hear you. But this is fantastic. So let's just keep going through it.
Makes it a little difficult. So if you remember, you guys, last week we had the CPI data coming on Thursday, the day after the show. And we had talked about some very valid reasons why we had every reason to believe they were going to be tame CPI numbers, and that would lead to lower interest rates. We also said, I wouldn't expect a big movement because the market's going to want to see 2 months. They're going to want to see a trend. They're not going to see 1 month, which could be an aberration. The Fed governors were out in force this week saying it could be a head fake, could be an aberration. So they're trying to talk the market off of last week's reaction, which was the biggest one-day improvement in treasuries since 2009. So in 13 years, saw over 30 basis point improvement in the 10-year treasury, just massive, massive improvement for a single day. The best news is that both treasuries and mortgage-backed securities have held those gains in the last week. So the benefit there is that it wasn't a one-off, that the market had this knee-jerk reaction and then turn around and give it all back. Now, I would say we want to look forward the next 30 days to the 13th of December when we will get next month's CPI figures. For the same reasons that we expected a tame CPI reading for this month, we expect another one next month. We're actually going to go through a chart here. When Jeb gets back, he'll pull it up and show you what we're looking at from that end. Any better luck, Jeb? Still can't hear me? No, nothing.
John, so just keep talking, dude. I don't know what to tell you.
Well, Darren says I need to learn how to read lips. So probably the most important thing is that you can hear Shaheedah, or we're gonna have a real hard time having that conversation. But what we were talking about is next month's CPI figures are going to be very important. PPI sort of confirmed earlier this week the same story as CPI last week. We had some strong retail sales numbers that normally would be negative for bonds and interest rates. Market kind of shrugged that off. So we'll get PCE later in the month, which the market has shrugged that off for 4 or 5 months now, paying much more attention to CPI. They trade the CPI figures and wait for the next month. So really, I don't expect them to get worse. Don't expect them to get much better until we see what happens with that December reading. If we get confirmation like we expect, and then we would likely expect the following month to get more confirmation that CPI is continuing to trend down. And let's put it into context. One thing we're going to talk about here shortly is we had a reading for last month of 0.3. So you say, oh, cool, a month over month reading of 0.3. What does that mean? If we had 0.3 every month for the next 12 months, we would still have 3.6% inflation level. That's not good. The Fed's preferred number is somewhere plus or minus 2%. So even though this last month was much better than what came before it and what was falling off from last year, still elevated, but moving in the right direction. And that's what the market is hoping to see. Any luck yet, Jeb?
All right, I'm back, Josh. I have no idea what you said during that whole 5-minute stint there, but I'm sure it was great information and people are loving it. So you can hear me. Everyone can hear me now. We're all good. No?
They can hear you, Jeb, because I can hear you perfectly.
No, you cannot hear me. This is great. This is awesome. So what do we do in this situation here, Josh? Do you just come in here? Do we have a show with one camera? Can we manage that?
We can give
I think we're going to have to. I don't know what else to do.
So why don't you bring Shaheedah in real quick and make sure you can hear her? Because if you can't hear her, you may need to come over here.
Let's see here. We are having major problems. Major problems audio-wise. All right. I don't know what to do here, guys. This is a fail. This is an ultimate fail on everyone's part that's involved in this, except for Shaheedah. She's just hanging out.
Everyone is hearing everyone. The only one that's not hearing is you are not hearing me.
Josh, I don't know what to do. I'm out. So I'm coming over.
All right. Wesley, yes, this is in fact amateur hour. You wouldn't be aware that we've done this for a year, but now how are we going to get another headset on here?
I have no idea. We're just gonna have to figure it out.
All right, let's go this route. See if we can crank the volume on that and see if anyone can hear.
Oh boy, what are we doing here, Josh? What is this?
Here, we're going to remove this Jeb Smith guy, and let's see here. Let's bring Shaheedah in and say,
hello.
Shaheedah, are you having any problem hearing everyone?
I can hear you guys well. Can you hear me?
We can now. Yes. This is
okay,
fantastic.
great. I was like, I have headphones. I was like, I need to be on like headphones like you guys. But yeah, I can hear you all well, and I could hear Jeb too.
Move over just a little bit. Yeah, no, awesome. Thanks. So welcome to the show, Shaheedah. We're clearly having technical difficulties, and I'm sitting on something much lower than Josh. So I look like a midget over here, but actually, can you say that? I look like a small person over here. Josh is going to find me a chair here. But anyhow, welcome to the show, Shaheedah.
Thank you
for being here.
Thank you for having me.
Yeah, absolutely. You're awesome. And you came on with we didn't even chat before. We just kind of set up a date and you came on and it's fantastic. And I probably should have tested the audio prior to doing this, but here we are. So
I've had plenty of audio problems. So
after 2 years of doing lives, you would think this problem would have solved itself, but clearly it has not. So, so here we are. So what we're going to do tonight is Shaheedah's on the channel. We have some slides that we're going to bring up, but what we'll do instead of, wasting Shaheedah's time, unless she wants to stay later than, the 30 or so minutes that we've allotted, we're going to talk to Shaheedah about what's happening in the Atlanta market, what she's expecting to happen over the next couple of months, what she's seeing in negotiating deals, buyers, sellers, all of that good stuff, really to help guide you guys in the right direction and provide some insight on a different market. Because here locally, we talk a lot about SoCal, but Shaheedah's in Atlanta, Georgia, different market entirely, different price point entirely. So maybe start the show there, Shaheedah. Let us know, maybe just start by introducing yourself for those that don't know you. Tell us a little bit about the information that you put out, and then, a little bit about what you're seeing at the moment.
Okay, I'm Shaheedah Hill. My YouTube channel is Shaheedah Hill. I have to put that in the chat, or Jeb have to put that in the chat so you can spell it. But I primarily focus on first-time homebuyer content and housing market content. My little tagline is getting you over the hill to home ownership so you can confidently buy your first home. So all of my content is really for first-time home buyers. I'm in the Atlanta area. And right now in Atlanta, we're still in a seller's market technically. I say technically because we're at like 2.6 months of inventory. But I feel, and this is October data because we don't have, November data out yet. But I do feel like we're entering a balanced market come November, December. It'll be a lot more balanced. Buyers are getting closing costs paid. They're getting, normal due diligence periods. They're asking for repairs. So we're definitely getting into a more balanced market here in Atlanta. But I would say affordability is still a huge, huge issue. Before the pandemic, in our largest county, like where Atlanta is, the average home price was $446,000 back in 2019. And now it's $719,000. So that's a huge jump. And with interest rates being, where they are, high sixes right now, it's, affordability is a big issue in Atlanta, especially for first-time home buyers.
No, and most of your first-time home buyers, are they coming in with like large down payments, or are they your typical first-time home buyer with small down payments?
Small down payments, we're talking about either like home ready, 3% conventional, FHA, 3.5%. Typically, they're not coming with high down payments unless they're leaving a higher income state. So if they're moving down here from New York and buying their first house, maybe they have a lot more cash than a typical buyer, but leaving a higher income state and coming here. Generally, they're not first-time home buyers. Sometimes they've sold their house in those states and they're coming down here with large down payments. So one of our benefits is, even though average price in the 700,000s is high for us, when people are coming from these high income states and moving to the Sun Belt, Atlanta, Florida, very popular, North Carolina, South Carolina. It's cheap to them. So where, our people that live here, they're like really, they're not paying that, but people that are moving here are still willing to pay those prices.
No, I get it. I look at this and I look at Josh in the background. He looks
creeping.
He looks like the kid that nobody really wants to talk to.
You gotta move Josh to the light. Come to the light.
Out of focus just a little bit. So
take your little brother or brother with you. Let him do the show too.
You should stand in the corner and just stare at me weirdly, just to make this really.
This may be a new thing for you guys. Y'all all at the same table and make it like the podcast style, and you see everybody in the same screen.
We've been talking about doing that for a little bit, and honestly, we probably should. It would.
This might be the trigger.
This might be the start of it. That's the spark. Like we remember this day.
Exactly.
So we started being in the same room.
It would make things. It would make the flow would be a little bit better because you wouldn't be cutting each other off and that sort of thing. But
yes.
So you mentioned earlier that you're starting to see some more deals on properties. So what does that actually mean for you? Are you seeing sellers? Are you seeing big price cuts? In the sense that. And when I ask that, I ask it in a way that if a home is priced where you think it should be, are you still seeing big price cuts? Are sellers just walking away from property willing to give it up? Or are sellers still negotiating, trying to keep a firm price, but more willing to offer things like credits and maybe some incentives to get buyers, willing to pull the trigger?
I think we're still trying to find that balance in the Atlanta market. I think some properties are definitely priced too high, but they're a little bit reluctant to go, really cut low, like not at 10% or 15%. They may go from 500,000 to 495, to try out those. But they're not doing major price reductions, but you're seeing a lot more marketing. You're seeing broker bonuses. You're seeing a lot more open houses, things that we really didn't have to do in the last 2 years. Agent caravans, broker opens, all of those things are happening a lot more. I think agents now, before they're lowering the price, they're trying to do all of those things. And then they're coming back to their seller and saying, hey, I tried this. It's not selling at this price. Now let's, go ahead and reduce the price. And we're in the Bible Belt, basically. So we're getting into Thanksgiving. We're getting into Christmas. If your house is on the market now, more than likely you have to sell it. Like if you keep your home on the market through the holidays in Atlanta, you're more motivated to sell it because nobody wants to sell it during the holidays. So some people may be taking their home off the market and putting it back on the market in January. So the feeling is if you keep your house on the market with Thanksgiving is next week, then you probably are very motivated, if not, have a high sense of urgency to sell.
No, and that makes sense. I mean, we see a similar movement in the market here. I mean, this is the time of year probably within next week, you're going to start seeing inventory levels go lower and lower locally. Mm-hmm. Every week I give an update here on our local inventory, Orange County wise. We're 3.3 million people here. Today we have the least amount of property that I've seen in probably 4 to 6 months, and we're sitting at 3,534 homes, I believe, coming on the market here in Huntington Beach. We're at 230. So we're kind of seeing that peak, if you will, and now we're starting to see inventory pull back. And part of it is because, again, seasonality, just, nobody wants to sell during the holidays, people walking through their house. And also part of it is sellers aren't getting their price. They're just, hey, I'm not getting my price. I'm pulling my house off the market. I'm not doing this. And some of those people will come back after the first of the year, and some may not, just depending on what happens with rates and what happens with, just the market in general. So we're definitely going to see a slowing, and that's going to mean less home sales. I keep talking about it. The data is somewhat skewed in the sense that, historically speaking, where this time of year is typically a slow time of the year. But the last 2 years were very, very busy, which was abnormal for the real estate market. And so, you're comparing numbers to last year, which aren't really fair in a way, because the last 2 years weren't normal with regards to pending home sales and existing home sales. Yeah, the market is slowing, but when you compare it year over year, it looks like the market's falling apart, when in all reality, it's not.
Exactly. And I did pull the 2019 number. So before the pandemic, we had 3.8 months of inventory in like one of our largest counties. So I would say we were in a balanced market then, but I feel right before, depending on price point, right before the pandemic, it was hard to find a house right before then. I was doing videos on, how to get your offer accepted, that sort of thing. Even then, like, my videos in 2019 were about how to get your offer accepted, because there weren't that many homes for sale.
No, same thing here. And that's funny because, I've gone back and showed a couple of videos prior to the pandemic and said, okay, Jeb, what was I saying during, the November, the October, the whatever, these months that we've just been through in 2019, what was I saying? And it's a very similar thing as to what we're saying now. Not a lot of inventory, home sales are slowing, things are still moving, you're seeing price cuts. It's more normal market. But what, we have short memories, as humans, and so we only remember the last couple of years. And if you haven't been in this business, or you haven't been looking for a home, most people haven't been looking for a home for 3 years, right? So they've only been involved in the home buying process, the last couple of years. If you're not buying a home, typically you're not following the data. And so even in a normal, quote unquote, normal market like 2019, if you will, most of the time, if a property is listed at, say, $400,000, you never go in at $400,000. You're typically going in under the price, trying to get some sort of negotiation going, especially this time of year. And we're seeing more of that right now.
Yes, definitely. So I think it's going to be, like I said, I think we're getting to a balanced market, definitely into this year, because seasonality is a piece too. And I think in January, I think we'll see, what the inventory levels look like again, to see if it's going to be, but people are negotiating. They're getting those closing costs. They're getting things that they typically wouldn't get in this market. And things are definitely staying on that market longer. I had that data too. Let me see. We're at about 25 days. So still, not a long time, but compare that to, before the pandemic, it was probably like, 12 days, 14 days. So
no,
it was half of that.
Absolutely. And the data just came out for California, and it says the average days on market's 24 days. I look at that and go, most properties here aren't selling in 24 days. Most of them are sitting 40, 45, 50 days, 60 days. Even when they're priced correctly, it's just a little bit longer time frame to make those things happen. Whereas, they're looking at the entire state of California. Some homes are selling, in 1 day, some are taking a little bit longer. So that data is a little bit skewed. But nevertheless, the market is slowing. And I expect, personally, I'll tell you, like here in California, I don't know what your market's a little bit different because the price point is a little bit different.
Yes.
But here in California, I think the market's going to continue to move sideways, slightly down a little bit for the next couple of months. It's going to be a slow, in my opinion, 3 to 6 months.
Yeah.
For people buying homes, for people selling homes, for real estate agents in general. I think you're going
Right.
to lose some people out there in this business that are new to the business just because there's just going to be less activity happening. And, I keep saying the professionals, that this is a professionals market, right? It's the
Right.
people that understand the business, that know the business, that can price homes correctly are going to be the people that continue to do well.
Yeah, because a lot of new agents don't even know what a normal market feels like. They don't know what it feels like to be in a normal market where people aren't, my house didn't sell in 2 weeks. What are we going to do? It wasn't, people just left their house on the market. It may sell in, 2 months. It may sell in 45 days. Like, it was very unusual for something to sell under 30 days, like get off the market that quickly. And you had to stage it and you had to show it, over a longer period of time. So I think there's no urgency on the buyer side because of the high interest rates. They want to see what's going to happen. And I know you were talking about the Fed and the CPI and all of that, like interest rates dropped like that. So if interest rates, people are looking at that and saying, okay, well, they meet again in December. Let's see what's going to happen again. Will they drop again? I heard a lot of, people talking about the 10-year yield is not going to go back over 4% anymore. So, and that's where it had been at the 7% and that sort of thing. So I think people are waiting and they're holding off to see what's going to happen because the Fed is impacting the market so much and they're moving very quickly. All these meetings, they're having an impact on the market.
Yeah, and it's a super aggressive stance, and rightfully so, based on the inflation numbers. I really wish I could have heard what Josh said earlier in the show, so I don't.
He was talking about the CPI.
Everything that he said, and for those of you just tuning in, I'm in Josh's office. I don't know where he went. He just left. I put him in the background. He left, and my computer is still here on the screen, which you guys can't see with no one in the chair. So we couldn't figure out the audio. So we're sitting here, but so the next CPI reading comes out on the 14th, I believe, 13th or 14th. So. And then the following day, the Fed gives their announcement. And I have some slides that I wanted to bring up, but they're on my computer, which is the other office. So they're not going to come up at the moment. And it basically an 85% chance that the Fed hikes 50 basis points in December. Josh is a believer that there's a good chance that they do less than 50%. But honestly, if you look at that probability chart or that chart, 85% are expecting a 50-point basis hike, and the other 15% or so are expecting a 75-point basis hike. There's nobody essentially betting for a quarter, and there's no one betting for a full point. So it's somewhere in between that half and 3/4. But again, a lot of it has to depend on what those CPI numbers look like in December. And, we have a chart, and once Josh comes in here, we'll throw that back up on the screen.
I'm gonna put my bet in at a half, just because I think if he goes too low to like a quarter, that would probably send the markets crazy. Like, oh, he's pivoting, like majorly pivoting. And
yeah,
I think,
and something Josh and I were talking about is, last month we came in with a 0.4 reading, and a 0.6 dropped off. I think the November reading is a 0.5 reading. And so if we come in again at a 0.4, inflation, the numbers are trending downward. But even if you had, a 0.2 reading, you need 0.1s and 0.2s for an entire year to get back to a 2% inflation rate, which is what the Fed is shooting for. So the idea of them, completely changing their minds on reducing the Fed funds rate probably isn't likely anytime soon. But what they are more likely to do is just pause in, the hikes, right? So the December hike, in my opinion, is probably the last hike that they're going to do for a period of time, and just kind of watch the data and see what it does. And if inflation continues to trend down, they might, I think it's likely that they'll continue, they'll stop with the aggressive hikes. Whereas, if inflation numbers go up, then you're likely to see them get back on it. But, it's difficult to say because we don't know, exactly what those readings are going to come in at, but we do have a really good idea, like we mentioned last week, that they're likely, even though 7.7 inflation is super high, yes, it is high. It's very high. The likelihood of it going down is really, really good just based on the way they measure those numbers year over year. So just keep that in mind. You're going to hear the news report that, hey, inflation is down, but that you're going to look at the market and say, well, inflation's still 7-something%. What do you mean it's down? Well, it is.
Right.
It's just, it's not at 8-9% like it was, 3-4 months ago.
Mm-hmm.
So
yeah, I agree. I
with
think
all
it's
that
going to be
said,
exciting to see.
Yeah. And with, inflation going down, interest rates should follow, right? I watched another podcast, Barry Habib. Many of you guys know who he is. If you're follow mortgage rates, follow the market at all. He's expecting, second quarter of next year that you'll see rates around 5%, plus or minus a little bit. So the trend is likely for rates to go down if inflation continues to decline.
Gotcha.
So all that being said, so let's take a break here and say, let us know where we can actually find you online, Shaheedah. So those those watching can actually go and watch your content. And I'll be honest, like as a first-time home buyer, you should be watching Shaheedah's content. And that's not me, promoting her and, like, hey, you're on the show, I'm doing that. No, it's
Right.
really good content for first-time home buyers. It's really about education. And she does a very good job of giving that information.
Thank you so much. I appreciate that. So now that we have these YouTube handles, I guess my handle is at Shaheedah Hill. And even if you spell it the way it sounds, you probably still can find me. So if you put in Shah Hill or something like that, you should be able to find me that way as well. So, or shaheedah.com, all of those things. So yeah, you can find me on there, all of those things.
Awesome. And actually, if you're in the description of the video, the title of the video, if you click on her name, it'll take you to our page so you can get there as well. So just,
thank you so much.
Yeah, no, if you're looking for good information. And also, I don't know if Shaheedah knows about this, but we have a podcast, Josh and I, where we talk about mortgage, we talk about real estate every week. We do a new episode. This past Tuesday, we did an episode on credit, everything you really need to know about credit, a deep dive. It's a 30-minute conversation, and we didn't even finish the episode. There's a part 2 of it coming out next week, but this will really set you up. If you're a home buyer out there, go check it out. Search The Educated Home Buyer, any platform out there, you'll find it. It's a really good source to guide you through that process. So check it out.
Yeah. Since you're podcasting anyway, you definitely should be together. I say y'all should be together all the time.
That's a lot. We definitely don't need to be together all the time.
All the time.
This is a lot. He actually just bailed on me. I don't even know where the hell he went.
He was like, let me get out of here.
It's all
you
good.
Got it.
I got an office that works. It's fantastic. So Shaheedah, do you have time? You want to talk? Do you want to take some questions?
Sure. If you have any questions or anything else about Atlanta, I can answer.
Let's see. So we got Jeanette Santiago says, Jeb and Shaheedah, how do you feel about buyers for 2023? Let us know your thoughts. What programs do you recommend? So kind of a vague question and not super specific, but what do you feel like the 2023 is going to be like for a buyer? And I know this is a stretch because clearly there's a lot of factors that have to play.
I think you have to be long-term thinking. Like you're not I'm going to live here for 2 years and then I'm going to sell this house. Just in case, we have a lot of things going on. We may not get into a deep recession, right? So you never know. So we want to make sure that you are, planning for any possibility, planning for, a recession, planning that everything's going to be fine. You want to make sure you plan. So if you're buying a house in 2023, make sure you are not spending a lot of money. I recommend under 35% of your take-home pay. I don't know how possible that is in California, but it's possible in Atlanta. So get that, amount down to a budget where you're comfortable with that budget. And then, make sure you're going to stay in that house at least 5 years. So you can, go through some of those ups and downs. I bought a house in 2023 for like $140,000. Right now, that house is $316,000, but that was in 2003. For the long term, you'll be fine. But if you're like looking at short-term numbers, it is going to scare you a little bit because you can have some volatility right now in this market. And I say for agents, Jeb, he's an agent, right? So your agent and he's here now.
Yep, he's back.
So you're an agent.
No, he's a lender.
He's a lender. Okay. Sorry. Lender. So great. I've been telling people, because I know a lot of lenders are saying, well, just refinance, just refinance. I just want you to think about, what if you lose your job? Do you have enough money? Do you have enough money in savings to make sure you're paying that? Just think of all of the contingencies when we're in an economy like this, to make sure you have enough money to cover. Like, this is not the time to buy a house and have no savings.
I think that's fantastic advice. Something I've been talking about a lot in videos. I mean, forever, but more recently than anything else, is just make sure you have a longer term time horizon. 5,
Right.
7, 10 years, I think is good. I even crapped on the idea that, a lot of people are pitching the idea of, marry the house, date the rate. I'm like, okay,
Right.
that's a great saying, but you have to be comfortable making that payment if rates don't go down, right? I
Yes.
expect rates to drop. There's an opportunity for you to likely to refinance, but there's also a chance that maybe your equity has gone down a little bit. Maybe rates didn't go down as far as you would have liked. And that payment, you don't want to be in a position where your payment is difficult to make every single month. I mean, a lot of big names out there that, whether you like them or you don't, Jeff Bezos, Elon Musk, these people are coming out making statements like, hey, listen, if you're making a big purchase, you might want to delay it. At least be careful in what you're looking at, because some of these people are expecting a bigger recession than others. And so it's just important to make sure you're buying for the right reasons. And again, you have money in the bank. So earlier you mentioned, Josh, I'll let you jump in here on this comment, but Shaheedah mentioned before you came on, she likes to tell buyers to be 35%, not to use more than 35% of their take home pay. And she laughed and said, I don't know if that's possible in California. And the reality is it would be very difficult to do that in California.
Yes.
And most lenders, for those of you watching, qualify you actually off, 45-ish % or so off your gross, not even your take home. So if you're not budgeting, if you're not doing some of these things that you should be doing up front, you could be putting yourself in a bad position, if you will. And that's not in this market. That's in any market. You just really need to make sure you know where your money's going. So
In all of it, yeah, Jeb, in all of it, the interesting thing is that why do lenders use gross versus net? Net's easily manipulated. Have you ever changed your withholdings? People can say, hey, I'm exempt. And now you have a much larger net check for a month or two until the tax bill comes due at the end of the year. You can put money into an IRA or 401k. It changes how all of that comes out. So lender's looking at a gross because it's same across the board. It's what you actually brought in. VA loans are one of the safest loans out there in terms of default rates. And it's because they use a secondary calculation, which is a residual income calculation. So it's sort of going at it the same way as Shaheedah is suggesting, of saying, what do utilities look like? What do your state and federal income taxes look like? And you calculate that all out. And you say, is there enough money here left at the end of the month to pay the bills? And not, again, it doesn't take into account discretionary spending. We've had this conversation before. Jeb and his wife may eat peanut butter and jelly at home every night, and I have the exact same family, and I want to go out and have a steak dinner. I better have much more residual income to be able to handle that. So it really comes down to knowing you and your family and how you spend money, what's important to you. But it is getting much more tough. Shaheedah, I heard you say earlier, you guys went from a $400,000 price to a $700,000 price. That's pretty consistent with everywhere in the country. The scale or the magnitude of it is different, right, but so are our incomes in an area. And one of the things that we've talked about here on the show every week is that the home prices matter, but they matter to the extent that it impacts the payment. So it also matters interest rates. So people are sitting here that are on the sidelines that haven't been able to buy, and they're hoping prices come down. I think the more likely thing for us to have happen in terms of the affordability equation, incomes will go up slowly over time. We're seeing pressures on income for some people who are being laid off and losing jobs. So a recession makes it hard for wage increases. So wage increases are pretty minimal. The biggest variable in there that might move and help people in the short term is interest rates. And no one should expect that they're going to go back into the 2s or the low 3s, but that's a big portion of that. When you see your home price go from 425 at 3.5% to 700,000 at 7%. Jeb, you've run the numbers. What was it? 58% difference in terms of the monthly payment?
Yeah, I don't remember exactly, but it was a substantial amount. Just that difference in, again, 3%. But I mean, I even talked about the difference in $50,000 in a purchase price versus, a 0.5% rate or whatever the number. And even then the savings is substantial. Just, most people think, hey, if I bring more money to put down on the loan, it's going to improve my payment that much better. And the reality is down payment versus interest rate, it's it impacts it very little, whereas the interest rate impacts it a lot. By having that interest rate drop a half, to 1%. I don't know what it equates to, Josh. You probably have an idea, but how much more money do you need to put down in order to get that same equivalent payment?
Well, it's about a 2.5 times difference, and we don't think of it in terms of an additional down payment, because most people, they have a finite amount of money that they have and are able to spend or are willing to spend. But in the current market, what people are asking is, hey, I want to go in, I want to cut that price $50,000. Well, at current interest rates, a price reduction, an interest rate reduction is going to have about 2.5 times the difference of what the price reduction does. So if we can take $10,000 and buy the rate down, that's the equivalent to about a $25,000 price reduction in terms of the monthly payment. So that doesn't mean that is the right thing to do, because we have to think long term. Once you pay for a permanent rate buy down, we're talking about permanent, we're not talking about a 2-1 buy down or a 3-2-1 buy down. That permanent rate buy down, once you paid for it, it's a sunk cost. The only way you recoup it or benefit from it is to be in that house and that loan for the long haul. If rates drop 2% next year and the value's there and you're able to refinance, that money is money gone. But in terms of pure qualifying, what do you qualify for? What are you comfortable with in terms of your monthly payment? The buy down funds will go about 2.5 times further than a price reduction. And you could say the same thing. Would I be better taking $10,000 and buying my rate down? Or would I be better putting $25,000 more down? That's the equivalent to get the same bang for your buck in terms of monthly payment. And most people are shocked by that, to see how little impact additional funds down or in the price reduction makes relative to a big difference in the interest rates.
No, good stuff. Oso said I would buy from her. Great personality and knowledge. So good stuff there, Shaheedah. We got Ty coming in saying, if a total fixer-upper is sold for $500,000, $300,000 under the market value for the same house in decent condition, would the property tax be assessed at $500 or $800 in LA County? So here in California, your property taxes are based off the purchase price in which you buy that property. So if you buy it for $500,000, your property taxes are based off that $500,000, regardless of what homes around you have sold for. So just with values going down, property taxes are going to get a little bit better. Here in the state of California, we have something called Prop 13, which limits the increases on your property taxes year over year. The most they can increase is 2%. So if you bought at $500,000, roughly a 1.1% tax basis or so $5,500 or so a year, it's not going to increase by more than 2% a year. Whereas some states have, if you buy it at $500,000 and your neighbor's house sells for $800,000, then your property taxes can go up based off the new sell in that neighborhood. How does it work in Atlanta?
It's market value. I don't think we have any caps. There might be some in some counties. Each county is assessed, does it a little bit differently, but for the most part, like, taxes went up significantly from 2021 to 2022. It's gone up a lot. So we don't have that 2% max. Definitely not in my county.
One of the few perks to living in California.
Yeah,
there's not a lot.
I'm surprised. I wrote that down. I was like, oh, really? I didn't know California had that. Y'all have
Prop 13.
When you do those pros and cons videos, that would be a pro.
No, it's there's like two: the weather and taxes. That's it.
And taxes, right?
It's just property taxes. Yeah.
Right.
What are you saying, Josh?
Another thing to be aware of on that, it matters when you're buying a fixer, whether you're buying it direct from the seller or whether you're buying it out of the MLS. In California, the assessor's office, if the home hits the multiple listing service, whatever it sells for, they're going to accept that as the market value of the home, assuming that multiple bidders saw it, could have bought, could have paid more, and the market determined this was the value. I think you guys that have been here long-term know I bought a house last year, was completely destroyed. It was a past client, kind of lost his mind, obliterated the house. We bought it for 500. We thought when it was fixed, it would be worth around $700,000. Since it never hit the MLS, I had to go to the assessor's office. When you file your preliminary change of ownership report, which gives them all of the details of the sale, you have to go through and tell them, why did I get this for so much less than what market value appears to be? Otherwise, they will go through and they'll say, no way, that house was worth $700,000. So we had to give them 50 pictures of showing everything that was done. We sent over the contractor's bid, and we actually got it assessed for $500,000. Now the market's gone up more since then, but again, thanks to Prop 13, it can only go up 2% a year based off of the limits we have in place.
No, good stuff. Here's a question. Yeah, good. Shaheedah, here's a question for you. How to get a realtor to give us basically a percentage of the commission, the way I read this, for working with us to find a house. Is that how you guys read it?
I think they actually have it backwards. They think that they're paying directly for a buyer's agent, and how could they get the lowest percentage? So maybe Shaheedah, explain how, as a buyer's agent, you are paid and what negotiation might look like there.
The majority of the time, and I don't know if this will change in the years ahead, but the majority of the time, the seller is paying your agent's commission as a buyer. Because that listing agent, whoever's listing that house, they're already under contract with their agent to pay them a set percentage. So let's assume it's 6%. The listing agent is being paid 6%. If they can't find their own buyer and a buyer comes to them that's already represented, typically they agree to share their commission with that other agent. So doesn't have to be equal, but usually it is. The listing agent will get 3%, and then the buyer's agent will get 3%. So, you're basically sharing that commission. So typically, you don't have to pay your agent, your buyer's agent, out of your own pocket. The listing agent is going to share their commission already, agreed to by the seller with they call it a co-op agent. They're going to share that with the buyer's agent. So you shouldn't have to pay them directly. If they are asking you to pay them directly somehow, I would, make sure you're meeting with multiple agents to see if they all, do business like that.
No, good stuff. I mean, that's a great way to look at it. That's a much easier way to answer the question than the way I was proposing it, which is where a buyer's asking you to give you part of the commission.
Yeah. Whole other story.
Yeah, whole other story, and probably not worth chatting about on here, but yeah, we'll just leave it at that. How's that?
Okay. Jeb, I always like to say, when people ask that question, say, okay, start that conversation with your realtor. If you can win that negotiation with your realtor, I don't think you want them negotiating with sellers on your behalf.
I agree. We've talked about it a lot on the channel. I mean, quite frankly, about, I don't agree with giving commission to help a buyer find a house. It's for many reasons. But I didn't want to put Shaheedah on the spot. And,
right. I don't agree either, but I think we've all probably been in positions where to close a deal, we've had to make, something, Absolutely. But nothing that's offered up front. If something happens, at the end of a deal, we're just trying to make it work, possibly.
Agreed, 1,000%. I mean, I'm a big proponent of getting deals closed, making both sides happy. Right. And if that takes, some changes in the structure of the commission, then by all means.
If you're approaching it from the beginning that way, well, how much of my commission already kind of changes the whole dynamic of what kind of client you're going to be. So I would definitely wouldn't, start with that.
Agreed. Let's see here. Josh, this is a question for you, and Shaheedah could probably benefit a little bit from hearing this too, unless she already knows the answer. Keep hearing about FICO 10 and FICO 10T. I know what's going to happen, but do you have an idea on time frame and in which that might take place?
No, we don't. And here, Jeb, here's the fun part. The follow-up question Jaleesa asked, when dealing with FICO scores, do they use version 5.4 or 2? Not quite as simple as that. So currently, Fannie Mae Desktop Underwriter, Equifax Beacon Score 5.0, Experian Fair Isaac Risk Model V2 SM. I've never even heard of that one. TransUnion is Risk Score Classic 04. As you guys just pointed out, version 10 exists, and yet we're still using version 5. And the difference is they just keep tweaking and improving the algorithm. As with so many things that are government related, they just get stuck with what they're comfortable with. Probably the more important thing to me, I'll bet that FICO 10 is doing some of the things that Vantage Score is doing, but we're also supposed to be at some point in the next year or two be able to use Vantage Score. We talk about disparate impact and how people of color, different communities are adversely affected by the current credit scoring model. Using a 10 or 15-year-old model, if you saw the numbers, you would be appalled at how indifferently or how differently those groups are treated. With Vantage Score, I think we end up with something like 10 or 20 million more Americans have scores, and people of color generally see a 5%. Don't quote me on that. I have a different presentation somewhere that shows exactly what it is, but it's a 5 to 10% increase in the scores. So that will have a massive impact. It has been approved. It's big on the FHFA's list, but I just don't expect those things to happen quickly. We're probably 1 to 2 years out before it goes into play. But a friend of ours was very big. It was bigwig at Vantage Score, and they've been pushing for it for a long time. So hopefully that 10T impacts or integrates a lot of what Vantage Score had done in terms of making scores more available to people who have less data or have been less scored in the current credit modeling system.
No, good explanation there, Josh. So I promised Shaheedah, or I told Shaheedah 30 minutes is all we would request of her time. So it's been 30 minutes. I understand if you got to go. If you want to hang out, you're welcome to hang out as well, as long as you want. So you let us know what you want to do. No offense taken either way. So
no. I'm gonna get the kids to bed in Atlanta because it's almost
Awesome.
9 o'clock in Atlanta. But I do want to say that's a very good point on the scores and how they, are making them a little bit more equitable for everyone. I would say this: don't bog yourself down. I don't really like it when people say, "Well, they're using the 4, the 5, the 6, or 7." To me, just make sure that you're everybody's gonna pretty much follow, like, are you paying your bills on time? How much is your debt to income? How much outstanding debt do you have? How much utilization do you have? Focus on those bigger things, and then all the models should, trend up. But when you get so bogged down because one lender may use one thing and another lender uses something else, and really focus, I think, on the overall. And if they officially start using these, more, they're more widespread, then go ahead and focus on it. But I think there's, at least for first-time home buyers, they focus on, like, what are they using? Which one are they using? Just, to me, try to overall, I know you had your podcast, try to work on those big things that are going to improve your score, probably in all of the different models for the most part. But hopefully a lot of times they're showing that credit scores are not, the best thing to use as far as long-term, payment, being able to pay back your mortgage.
No, good stuff. I appreciate you being here, Shaheedah. If you don't know who Shaheedah is, go check her out on YouTube. I'm sure she's on all social media platforms as well, but she has a great YouTube channel, a lot of first-time homebuyer information. Her link, all of her information's in the description of this actual episode. So go check her out. Shaheedah, anything you want to say before you jet and take the kids to bed?
Nope. Thank you so much. Happy holidays.
Absolutely.
Happy Thanksgiving, everything. Thank you, Jeb, for having me on. Josh, nice
Absolutely.
meeting you. I need to have you on my channel next. Where do you do
I'm
loans? You do loans
available.
everywhere?
We're in about 18 states. So
Okay.
Georgia is not one yet, but it is on the list. We're in Florida. We're in Tennessee. So we're going to cover the South.
Gotcha. So thank you so much for having me. I appreciate
Awesome.
you guys.
You're welcome. All right. Talk to you soon.
Bye-bye.
See you guys.
All right. Bye-bye. And to follow up to what Josh and I were just talking about there with regards to credit, again, plug the latest episode of The Educated Homebuyer this last week, credit part 1, everything you need to know about credit. We actually dive into the credit model, what you need to work on, the changes that are coming with the different credit models, all of that stuff. And then part 2 will actually be released next Tuesday, because it was going to be like an hour episode. Instead of making you guys listen to that entire thing, we cut it into 2 different episodes. So it's a little bit easier to digest. So with that said, for those of you just tuning in, I'm in Josh's seat. Josh is in a different office. I don't know, Josh, did you go in my office and try to figure this thing out at all, or no?
I was worried that I might ruin the cockpit, so I just came over to Kassem's office, and I did grab one of your cameras and threw it on Kassem's computer and grabbed your light. So the light's about 8 feet up there. So it's not the greatest, but you can hear me, you can see me, it works.
Well, if you want your little area back, I'm happy to go the other direction and we can figure it out. But so that's where we are at the moment, guys. You gotta make things happen you probably shouldn't be logging on 1 minute before the episode's supposed to air trying to figure this out. But
well, what if we had 80 episodes with no incidents? You get complacent. You think it always works, right? Because I was having issues, and then you were trying to say it was me, and I'm like, bro, I'm telling you, I can see my little green bars when I'm talking.
No, agreed. I couldn't hear anything. And so that's where we're at. So James says, will the replay be a podcast? Yes. So every Friday, this episode will post on the podcast as a full episode. There'll probably some editing in it this week where we cut out all the craziness at the beginning and you can actually get a good show listening to it.
Jeb, and we have made epic progress on getting the podcast onto YouTube. So this time next week, we'll have at least 4 episodes up. And by the end of the year, all of the episodes will be available on YouTube.
Oh, good stuff. Good stuff. All right. So we got some questions here at the beginning of the show. Wesley says, is this amateur hour? It is. It was absolutely amateur hour. We're a mortgage pro and a realtor pro by day, not professional video content creators, any of that. We just play it a couple times a week. The professional jobs are other places. But let's see here. I thought this comment was interesting, and I just throw it up here. It's not a question, but it says, I'm a seller, already lowered my price from the original listing, which was below the appraisal. 8%, lowered the price 8%. Entertained investor offers. No offers from any retail investor. So only investors offered, but they're not going to drop their price. They'll entertain counters. So this is a seller likely in a position where they don't have to do anything and they're looking for their price. And I believe a lot of the market, quite frankly, is made up of people in a similar position. If you're having to sell, it's a little bit different market. But if you're in a position where you'd like to sell, if it makes sense, I think you get a lot of homes sitting, which is essentially what you've seen. And that's why I think you've seen inventory levels stay higher than they should be otherwise, is because you got some of these homes that are out there that, people are sellers, but are they serious sellers? Somewhat debatable. Just looking, blah, blah, blah. Says, what happened with the email newsletter you were going to send out? That's a really good question. I haven't done it yet because a lot of the information I've compiled is local Southern California market information. And I've got people from all over the state looking for information. So I'm looking for a really good data source so I can send better information out to everyone versus just my local market, which a lot of people don't care about. So it's in the works. On top of a lot of other things that I'm trying to figure out, but the email list is compiling. And once I get it figured out, I will start sending those out. So it hasn't gotten lost. It's just, there's a lot on my plate. Rafi says, what is the true cost of refinance and what are the requirements? So Josh, what kind of requirements do you need to be able to refinance? Yep.
Before we even answer, we got to give Rafi a massive congratulations. His transaction was supposed to close on Monday, buying his first home. It actually closed today. Had a unique situation. There was an unknown lien attached to the property. It took us for a couple days to track it down and get a payoff demand. But as of now, he is officially a homeowner, and that's why he wants to know when he can refinance and what it's going to cost. So jumping into that, requirements are generally very similar to the purchase. We have to document on a standard loan. So there are exceptions to what I'm going to say in terms of document your income. The exceptions there are FHA and VA loans. They have streamlined refinances that don't require re-income qualifying. But for a conventional loan, you're going to qualify with your income. Generally, the assets are less important other than really big loans. Sometimes jumbo loans, we're going to document assets. If you're taking cash out, sometimes they want to see reserves. The assets are much less important unless you're bringing in cash to close. Credit requirements are going to be the same. And they're going to go off a loan to value. So you're most likely going to have another appraisal. When home prices were appreciating rapidly and rates were really low, both Fannie Mae and Freddie Mac have got super loose with issuing property inspection waivers. Now they've tightened up a ton. We were getting them for anytime we had a 780 plus credit score and 20% down on a purchase, we could almost count on getting them. I've had several 800 plus credit scores with 20% down here recently and not getting them. So most likely basically you're going to have an appraisal, you're going to document your income, simple process. The cost of it is going to be anywhere, depending on whether we need that appraisal or not. We would negotiate the costs of title and escrow down to a bare minimum. So cheapest you're going to get out of there is about $1,500. Worst case should be about $3,000. And there's always the option of getting a lender credit to cover those. It's not going to get you the absolute rock bottom rate, but what we can see is that way you have no sunk costs. And we have clients, the last 15, 20 years have just ridden no cost refinances down all the way. So hopefully that answers the question.
Well, then you have Jessica also following up with a similar question, basically saying everyone talks about the process of refinancing, but is it really as easy as people say it is to do so? Can you explain the process of what refinancing looks like, Josh? So real simple. What does the process of refinancing look like? Does it look a lot like the process of when you bought a house?
It does, but think about it. There's no agent. So instead of dealing with me and then going to Jeb and go looking at houses, we don't need a realtor to show you houses. You don't have to find a house. You don't have to make offers. You don't have negotiations. You don't have sellers. You don't have an agent on the other side. You just have your loan officer. They're going to deal primarily with escrow and title. Like I just said, we have negotiated low escrow and title fees. We deal with them all the time. So other than signing your escrow instructions and signing your loan docs, you're not going to have to do anything on that end. So it is much more simplified and streamlined relative to a purchase. You're still going to provide your income documentation, might need assets. We're going to have an appraisal, but for the most part, you're going to do your application. So let's say Rafi in 6 months rates are 5%. He's going to call me up. I already have his loan application. I'm going to go through with him. Still on the same job. Is your girlfriend still on the same job? We're going to go through that and just update anything that may have changed. I'm going to get pay stubs and W-2s, get a copy of the mortgage statement, pull a credit report, run it through the automated underwriting system, give him a couple of options. Do we want a lender credit? Do we want the world's lowest rate? He picks that and we're off to the races. And in the current market, it'll take no more than 21 days. So it is much easier in terms of a compressed time frame and way less people that you have to deal with than a purchase. But from our end, the loan is really similar to a purchase, just with no realtors involved.
No, good stuff there. Kim says, did you bring your choice of drink over to Josh's office? I did not. I was in a bit of a state of hurry and rush and came over here, nothing to drink. So just parched. At some point, I might have to get up. So we'll see what happens. We got some good questions here.
Hold on, though. Before we get to that, for those of you that don't know Jeb, the way I am fortunate enough to know him, when he got up and said, had enough, I'm out. Jeb is a highly impatient person. I literally thought he was packing up and going home, and Shaheedah and I were going to be left to do the show on our own. So I was happy when he came to my office rather than just abandoning us.
That's too funny. In fact, if Shaheedah wasn't here, I probably
you would have gone. You would have been gone. Shaheedah is the only thing that kept you here.
It would have been you by yourself. Another good question from Kim says, is it better to include your yearly property taxes into your monthly mortgage payment? So Josh, I know that some lenders require this, right? Some mortgage programs require you to impound. It's called impounding your taxes and insurance into your mortgage payment. But maybe talk about what programs don't allow it and whether or not you think it's a good idea. I like it personally. My taxes are impounded. Over the last couple of years, putting your money in the bank, you get nothing on it really interest wise. So just, having it taken out makes it really easy for budgeting, because at the end of the year, my taxes are paid. I don't have to think about it. It's a done deal. But what are your thoughts on it?
In terms of loan programs, FHA is going to require you to impound. VA does not require it, but most VA lenders will require it. So if that's important to you, work with a broker who has options, because I've got options that will absolutely let you not impound and others that will absolutely require you to impound. Conventional loan is going to come down to how much you put down. Anything 5% or less, you're probably going to be required to impound. At 10%, you can start making the decision. But I come down on this the same as Jeb. When I got in the business in the 90s, the first few people I talked to were like, I'm not making a free loan to the lender. You keep my stuff separate. So when I bought my first property in 1997, I'm like, I'm keeping that separate. And then when I bought my second property, I said, that was for the birds, having to remember to write this big check to the assessor's office for my property taxes every 6 months. So I include it on all of my properties. It's just easier for me, but it's personal preference. Some people love control and they like writing out checks and remembering due dates for bills. So if that's you, there's no right or wrong answer. Just talk to your lender and find out if it's an option on the loan that you're getting.
No, good stuff there. Something that isn't mentioned enough on this channel is that Josh and I are here to provide education. And one of the goals we have is to help as many people with the education process as possible when it comes to buying a home, financing a home. And one of the ways that you guys can help us is by liking the video, subscribing to the channel. It helps us, again, it helps the YouTube algorithm, if you will, get in front of more people by doing that. But more importantly, it just helps more people see the video and ultimately gets us closer to education and really providing useful information. We're here every week for 2 hours. I don't know what week we're on, Josh, this year. I think we've missed maybe 2. So we're going to be headed into really 100 hours of home buyer content. So if you find any value at all, hit the like. If you're here every week and you don't even like us, but you listen to the information, like the video if you don't mind. It would greatly it would be appreciated greatly by both of us. And then one other thing I'll say is that if you're looking to find a lender anywhere in the country, a realtor anywhere in the country, there's a link scrolling the bottom. Check it out. Go there. Happy to refer you to somebody, even if you're 6 months out, 3 months out, a year out. Go have that conversation and know exactly where you stand. A little bit of context behind that statement is that I had somebody call me a couple of days ago. They were actually just searching online and they found me, and he calls me and says, "Hey, look, I'm looking to buy a house in the summer of 2023. When should I start having conversations?" And I'm like, now, like, you should be having the conversation now. And you're like, well, that's 6 months out. It is. But let me tell you what having that conversation now does. It, for one, gives you some insight on where you actually are in the process. This particular buyer had $30,000 in a 401k to buy a home. He wanted to keep his payment around $2,500 a month. I know in my head that's going to be very difficult to do, but he doesn't know what those numbers look like. So for him, it's useful to have that conversation with a lender like Josh, with a lender like, a lot of the other states, actually anywhere in the US that we can refer you to, but they're actually able to have that conversation and say, okay, if you want to run your credit, we can run your credit. We can see exactly where you are with your debts, with your credit. And so, hey, if you want to purchase in June or July of next year, you know exactly what you need to do down payment wise, credit wise, if there's issues, and what to expect, when you're ready to buy a home. So just, again, a long story with a really simple point. It's never too early to have that conversation. So that link will get you to a lender where you can have that conversation. We got a $10 super chat here from Mr. Let's see here. I can't see it because of here we go. Mr. Simon says, I own land outright. Can I do a mortgage just so the lender makes the payment for me? Can they pay the HOA for me? So Josh.
Lenders won't impound the HOA. I don't.
Oh, there you go.
It's interesting that they won't. You would think they would want control of as much as possible. It's really not all that different than the insurance. They want to make sure the property's insured, and they want to make sure the taxes are current, because that can become a lien. The HOA dues, if you miss them for long enough, those can become a lien. I've just never seen a lender willing to do it in terms of the HOA. And in terms of putting a loan on it just so they'll pay the taxes and insurance, you can put a loan on the property for any reason. If it's land, a land lender may be different, but I don't see why they would be. We don't do a whole lot of land loans. We don't have a ton of vacant land in Southern California. And when we do get them, builders snap them up and throw 3 or 4 or 12 houses on them.
Yeah, but if you're getting a loan just to impound your tax and insurance, I would say save your money. I mean, just set up a savings account where you put that amount of money into it every month, just like you would a mortgage, and then you'll have it in there at the end of the year, and it's done every single month. You don't have to worry about financing the cost. You don't have to worry about having a loan on a piece of land that you really don't need, unless you did need it for whatever reason. So hopefully that helps you out there. But again, thank you for the $10 super chat. Much appreciated. All right, Josh, let's see here. Graham shows up every week. And this week he says, would you guys support a federal bailout?
Well, not just this week, Jeb. He asked 47 times last week. So somehow he's obsessed with the federal home builder bailout. Why would anyone be in favor of any bailout, Graham? Why would we bail anyone out for any purpose? We don't, privatize gains and then publicly share in the losses. So no, simple answer. But you could ask it 57 times if you'd like. We shouldn't.
Yeah.
So no, do
No,
I
we
personally support it? I don't. So hopefully that helps your evening.
Yeah. No, I agree. I don't think we should support home builders in any sort of bailout. Again, like any other type of business, you gotta budget, strategize, know what the market's doing, and plan accordingly so that you don't get yourself in a position. So I'm against it. Orange says, any insights into adaptive reuse properties, repurposed factories converted into condos? So here locally, we don't have anything like this. One thing that may come about in the future is Westminster Mall at some point might be, I know there's some talks about some sort of development there. So that could be what I'm assuming it would be an adaptive reuse property, Josh. But outside of that, I don't really have a lot of thoughts on it. I mean, I do think some of these places that have, vacant buildings, large scale properties like this, I mean, it would be nice to have them turned into housing. But again, I don't know what that looks like in the big picture.
Some of the stuff I've seen online is really cool. They've built loft spaces, done cool stuff in terms of redevelopment. But Jeb, we do have one already approved and on the books here in Huntington Beach. They're going to turn the Burlington Coat Factory into retail with apartments over the top. So for us, the reason why we don't talk about it a lot is it doesn't become resale housing. Everything is luxury apartments in Southern California because that's the highest return on investment for developers versus actually building new housing stock. So as much as the state of California loves to talk about affordable housing, they will make the developers make a portion of those units affordable. Affordable is an interesting definition, but we just keep getting lots and lots of nice new apartment buildings.
There you go. Question from Dina says, you guys may have already covered this, but is there a good finance mortgage calculator to help plug in numbers to buy a house? And plan. So Josh, do you have any online calculators that you recommend? I mean, I use an old school mortgage calculator from, back in the day that, you got to know how to work it. But there's a bunch of online ones that do the same thing that are much easier to operate. Any that you are your go-tos if you don't have your phone or what have you with you?
No, because I always have my phone. So I always go there and most of the stuff is in my head. So let's give a plug to another one of our buddies, Kyle Seagraves over at Win the House You Love. He built a really cool tool in a website called Grid. It's basically a spreadsheet on the back end, but it's a Grid front end where you can plug in all your variables. And it does a really good job of calculating a lot of information for you. And it's better than almost anything available online. We have some pretty good calculators and we've built those into our website. But again, I wouldn't say there's only so much you can do with the calculator. So I don't feel like anyone has one that's massively better than anyone else's. Kyle's is as cool as I've seen.
There you go. Good stuff. Let's see. Giovanni says, thoughts on using 100% leverage in this upcoming 2023 market, more risky or same as always? So I don't know how you can use 100% leverage unless you're a veteran, and in which case I would always use my VA benefits if I was in that position and I could afford the payment and it makes sense. But yeah, I think there's a little bit more risk in 2023 than there was previously, just because of the economy, the recession, job layoffs, the unknown with regards to interest rates. There's definitely more risk. We talk about having that longer term time horizon. We talk about being comfortable with the payment, money in the bank. These are all things that you should do in any market, but super important in the market that we're headed into after we've appreciated 40+% in 2 years, right? That's not normal. The average appreciation over a 65-year period, I think, is like 4.6, 4.7%. So when you go up 40% in a 2-year period, you're expecting some pullbacks in home prices, and again, it's all local depending on what market you're in. Some will see a little bit more, some will see a little bit less, but yeah, just be careful.
Jeb, we have another question here that it kind of leads to the same point. Should I get 100% LTV first-time home buyer mortgage, a 5.9% ARM, or save up for a down payment? Here's the thing. I think both of these folks, if they had a big 20% down payment sitting there, they wouldn't be asking this question. They would just make a 20% or a 10% down payment. So if you have no money and you're saving and you want to buy a house, I'm not saying I'm right on this. From my perspective, there's no difference. 0% down, 3% down, maybe even as much as 5% down. So the last question was, is it more risky? And you answered it correctly. It is more risky in the current environment than it was anytime, say, prior to the end of 21 or 2020. But what is the risk? What are you risking? If you have access to 0% down financing, you're risking your credit is essentially all you are risking. I'm not saying that's a trivial thing. It's an important thing. But if I had the choice of buying a home with 0 down or putting 3 or 5% down, I'd do 0 down because I don't see there's any appreciable difference. And I would rather have that money under my control in the bank when there is a potential for a correction in the market.
There you go. Good stuff. And somebody asked for the link to Kyle's calculator on Win the House You Love. I just threw it in the chat. So hopefully that's helpful and that shows up on your end where you guys can check that out and go visit Kyle over there at Win the House You Love. Let's see here. Daniel says, do you think moving forward in this market, seller financing will be more common? Yes and no. Potentially. I mean, here's the thing with seller financing. What most people don't understand is that seller is really only able to give you financing when they own the property free and clear, or have a large amount of equity in that property. Otherwise, and they got to have money sitting on the side where they don't really, necessarily need to obtain that financing. Or does that make sense? I don't know what I'm even saying. Basically, is it going to be more common? I think maybe a little bit more, but again, you still have to have that seller has to have a lot of equity in order to be able to provide seller financing for a buyer coming in. Make sense, Josh? Did that sound right? I'm over here reading something out the corner of my eye.
Yeah, no, the reality of it, don't be reading my personal stuff on my computer over here.
I was reading Kyle's calculator.
So it would be more common, and I shouldn't say that because, Jeb, what are the numbers? I think the numbers nationwide, like 34% of homes are owned free and clear. So right. Anyone selling one of those properties could finance you. They would have to want to and not want access to their money and see a return on that. At current rates, they might like that. But the problem is, let's go back. We're going to keep talking about my first purchase. In 1997, bought my first home. It was a condo, and the owner owned it free and clear. And she, for tax purposes, wanted to carry the note on it. So should you put 10% down, no mortgage insurance, 6.875? I thought that was amazing. I told my wife, I said, we'll never refinance this. I can't imagine we're getting a rate under 7%. It'll never go below that. So a little context time-wise. But with that, she, for tax purposes, didn't want to get paid on that. Well, as soon as she makes the loan, she loses control of that. I could pay her off anytime I want. There was no prepayment penalty. Sure enough, rates dropped to 5% about 2-3 years later, and we went to refinance her, and she was not very happy about that. But I did offer her the opportunity to reduce my interest rate. She said, no, go ahead and pay me off. So long way of saying you have to have someone who has the equity in the property or is willing to do a second mortgage, and you then get a first mortgage ahead of it. And then they have to have the interest and the willingness to do it. And it's just not super common. And I don't see that changing to a significant degree in the future.
There you go. Jessica says, realistically, what could someone who is worried about the interest rates but wants to buy a home in the next 6 months in Southern California do to successfully buy a home despite the high rates? So I recently did a video on my channel talking about, hey, listen, if you're looking to buy a house in 2023, there's really 3 things that you should focus on. The first one is budgeting. It sounds crazy, right? I'm giving you really basic advice, but now's the time to go through all of your expenses and see what you can cut. Like, are you going to Starbucks every day? Are you paying, Netflix and, in my case, Disney Plus and Hulu and every, streaming service in the world? Is there anything that I can cut and then take that money and sticking it into an account where it helps build my ability for a down payment, puts more money there for me to put me in a better position to buy a home? Really work on that down payment. I mean, budgeting for me is about, in the next 6 months is about figuring out, okay, where can I get money from that helps me buy a house that makes that home more affordable? And the second thing you can do to offset interest rates is credit score. Now, if you have great credit already, this doesn't really work. But if your credit score is meh, if you will, like, it's good, but it's not great, going from a 700 to an 800 credit score, there's a big difference in interest rate. And that little bump in rate can improve your monthly payment and in turn making that home more affordable. So I would work on down payment, and I would work on trying to figure out how to boost my credit score as high as possible over the next 6 months. And maybe it means putting less money down on the property and taking some of that money you were going to put down and helping pay off some credit cards, helping improve that credit score. And I don't mean go out and get a credit counselor or anything. That's not what I'm saying at all. I'm saying use the methods that I talk about in that video, How to Buy a Home in 2023. That's the title of it. And from there, put yourself in the best position so that when, all of those things, fire at the same time, if you will, you're putting yourself in the best position to get an offer accepted and be happy with that payment. So outside of that, there's not really a lot you can do. It's really just, again, we talk about buying when the right time in your life. And it sounds like maybe 6 months is that time for you. Just those are the things that you can control. And those are the things I would focus on.
Jeb, we've said this a billion times here on the show. Talk to a mortgage lender now, before you do any of that. All the things that Jeb said are great ideas, but you don't have an optimized plan until you go through it from a lender's eyes and reverse engineer it. Here I am today. Here's what's going to change over the next 6 months. How do I allocate my resources? It may be saving aggressively. It may be paying down debt aggressively. It may be paying specific debt that you think is better than another debt, but we can get a score up. We can get a debt to income ratio in line better. So there's a million things that we can do to advise you. You still have to go and execute that plan, but we can help you get that plan. And Jeb, you'd probably also say not too early to meet with a realtor and get a feel for the market in the areas you're interested in buying, and maybe just let them know if you could buy right now, if the right property popped up, you'd be a buyer.
No, absolutely. I think that great information. Anya asked, will you have a show next week, Thanksgiving Eve? Yes, the plan is to have a show next week. If it goes anything like the beginning of this show went, it will be canceled really quickly. But no, the plan is to be here next Wednesday. I don't know if Josh is going to be around, but I will be here, again, for at least an hour, providing as much information as possible. More, I think we could probably just have more fun than anything else if you guys are up for it. But yeah, we can definitely be here. So, Josh,
can it be Turkey Wing Wednesday?
It can be anything we want it to be, Josh. I mean, tonight it's me sitting in your seat, you sitting in Kasim's desk. I mean, this show could be anything you want. They say, as a kid, just dream about where you want to be in life, and eventually you'll get there. And I've always wanted to be in your chair, Josh.
There you go.
Here I am. It's almost like being in your shoes, but I'm in your chair. This is fantastic.
You got my headset, you got my chair, you got everything, man.
I don't like the headset because I can't hear you in the headset. Or no, I can't hear myself. I'm sorry, in the headset. I just like when it's plugged in. I just muted myself. I don't know. What the hell did I do?
Tap the center button. It should bring it back on. Did that work?
I think so. There we go. Look at that.
Awesome. Jeb is a menace to technology, and this is a computer science major. He has a degree in computer science, and you can see how well that served him.
I am technologically savvy, and I don't know what happened on my computer in there. Somebody went in there and broke something. That's all I'm going to say. Riddle me this, Jeb. Why would I want more people to see the video and become educated than compete with me for homes? Well, what you have to understand, Wesley, is that this is nationwide. This is, and it could be global in some extent. Some cases. So the chances of somebody in your market watching it is unlikely, in my opinion. Does it happen? Sure. But again, I don't think it's likely that will happen. And at the end of the day, don't you want to help more people? Isn't that what it's all about? So I would say refers anyway. Like
we got a couple of really good comments, as good as Wesley's here. Wesley is almost always good for one of the top 3 comments of the week. Teresa Timms pipes in, instead of Turkey Wing Wednesday, we should have boozy pumpkin spice lattes next Wednesday for the win. So if you guys all want to get a boozy pumpkin spice latte before rolling in at 5 p.m. Pacific, let's see how that goes. Should Jeb and I get drunk and answer questions for 2 hours next Wednesday?
My wife would say no to that. Josh and I are pretty down to do that. I think it'd be fantastic. Have you ever listened to the Tim Ferriss episodes where he gets smashed and he answers questions?
Jeb and Josh unfiltered. I say we do it.
It couldn't be any worse than that. So there's a possibility. Anything's possible. How's that? Anything is possible.
Now the other one, Jeb, it's a shame. Hold that. Stay there. Right. It is a shame that you are not at your computer where you can do a poll, because Simon wants to know if the plant is fake or real. I want a poll to see if you guys think my plant is fake or real.
That's fake. It's fake. It's going to die. Nobody in this office is watering anything.
All of the plants are fake. We have no real plants. That's how they look so beautiful on video.
There you go. DJ says, building a home, closing in December, lender comes with no closing cost, refinancing. Is there a catch to this? I am a first-time home buyer, so I wouldn't even know what to ask. Sounds good, though. So, Josh, builder's promising, a refinance, no closing cost at some point in the future. What are your thoughts?
So here's what I would say. I've yet to find a builder's lender that's competitive in terms of pricing. That's why you get the big incentive from the builder to use them so that they can get in the ballpark of competitive. So them saying they'll give you a discount, highly unlikely to equate to anything that you would actually want to use in the future. I don't know that I've ever heard of someone using the builder's lender and then going back and refinancing with them. So it makes for good marketing. You've seen the biggest lender in the country has come up with two giant marketing gimmicks here recently. One is they're going to pay 1% of your interest for the first year. And then the second one is they'll do a discounted refinance for you if rates drop in the future. And the thing that I would say to that, and it's the same answer to this, absolutely. Call them up, get a loan estimate, see what the numbers are, and then call a local broker, call your local bank, and compare those figures. The last time I went head-to-head with Rocket Mortgage was on a $720,000 purchase. We were 3/8 lower in interest rate and $18,000 lower in closing costs. So that's how they can afford to pay 1% of your interest for a year and offer you a slightly discounted rate. So, and I don't ever expect anyone to take my word for it. So especially with Rocket, by all means, call them up. Spend 30, 40 minutes with the kid on the phone, and he'll keep you there to make you think that this is what it takes to get numbers from anyone. Then they'll send over the terrible numbers and then get with someone local and compare and see how much they're charging you after their discount.
There you go. Good stuff. While we're about to get another question, but I thought we'd just look at Jeb's office there.
Jeb's office is broadcasting live.
It looks a little sad. It's sad looking at it like that, guys. See that? Just no one there. It's lonely. It's lonely. I'm Josh Lewis. Josh Lewis is Josh Lewis, and Jeb is nowhere to be seen. All right. Well, we'll pull it out. I do want to ask. So we had quite a few clips that we wanted to put on here. Do you guys want to see some of the slides that we were going to throw on here? We could talk about them. Has to do with money supply. Has to do with supply in the market. Some of them are here local, talking about Orange County with regards to inventory and just, what's happening, with inflation and some of that stuff. So if you want, I can go to my office, throw those slides on so that we can actually go through them. So let me know if you guys want to see them. But in the meantime, Boris says, say you get a massive pay bump after buying a home. How long would you wait to start searching for a home? So the reason I put this question up here, this is a personal question depending on, where you are in your life. So I would say whenever you're ready to make that move, if you feel like the current property isn't serving your needs. But Josh, do you have to be making that new amount of money for a certain amount of time before you can start applying it to the mortgage process to be able to qualify for more home? Or does it immediately take effect? Day one, I get a pay bump, I'm ready to go.
Fixed pay or variable pay. So let's say you make $200,000 a year and they go, hey, we're going to give you a big pay raise. Next year, you're going to get a 20% bonus. I don't have a 2-year history of it. We can't use it. Let's say, hey, you're also going to get a 5% commission on all sales next year on top of your base pay. Can't use it. But for anything where we have fixed pay, so if you make $100,000 and they give you a raise to $200,000, that's fixed pay. You're going to get paid that amount every month, so we can use that immediately. I have a client right now. We didn't necessarily need it, but we the underwriter came back and conditioned because they had the employment letter in the file and said, get us the first pay stub. So before we close, we have to show the pay stub at the new pay rate. Jeb can't hear us. He can be at his desk, but he can't hear us. So it doesn't matter that he's over there. But we actually had a really good response to this in the comment thread. Simon Smith followed up and said, my advice as someone who's had payouts from selling companies and pay raises and then spending all that money, don't change your lifestyle, save the raise. There's some good advice in that. And just remember, you bought the house that you're in currently. It worked for you. There's going to be some fairly high costs in selling it. There's going to be a higher interest rate and some costs in buying it. And you don't have to do that. So by all means, if the pay raise makes something possible that you really feel the need to have, go ahead and do it. But consider that you don't have to do that just because you're making more money.
All right. I thought I had to sneeze. I do not. So we're moving along here. So I have those slides we'll put up here in a minute, but we have some questions. Evening, fellas, from Mr. Abs says, I love that one. I don't know what his name actually is. Is an ARM a viable loan option now? Our lender mentioned conventional was actually offering better rates at the moment. Can you explain assuming a mortgage and its benefits? So there's a lot of questions. So two different questions going on here. So Josh, are 30-year fixed rates actually better than most ARM rates at the moment? Is how I would ask the question.
Yeah. And you and I had this question this morning, and even going back 6 months, 6 months ago, when we actually had a steeper yield curve. You guys have heard probably in terms of recession, we talk about the yield curve's inverted. Short-term rates are higher than long-term rates. Well, that makes adjustable rate mortgages less beneficial because the lenders who make those loans go, well, it costs me more to borrow short, so I need a premium for that. I'm going to charge you more. But even in a normal market, Fannie Mae, Freddie Mac, FHA, VA, the ARMs aren't super attractive. They have been at times, but in the last 10 years, I've never seen a compelling case for it. With the portfolio lenders, there are portfolio banks. The portfolio lender that we talk about here that I have access to in the 8 Southern California counties, 2-3 months ago, a 7-year ARM would be a half to 3/4 lower than a 30-year fixed, and it starts making sense at that point. If you can get a 10-year ARM at a 0.5% lower than a 30-year fixed, that makes sense. Right now, the rates are pretty much the same across the board, so you just take the 30-year fixed and get the free insurance for or against higher rates in the future.
Good stuff. One thing, if you're watching at the moment and you haven't done so already, hit that like, hit the subscribe button. Again, help us accomplish our goal of educating more people. And at the same time, if you haven't, check us out on the podcast. Looks like that up there in the corner. We would both appreciate you doing that. So with that said, Josh, we're going to throw up some slides here on the screen. The first one is what we're going to talk about here. It's inflation peaking. So last week we talked about, we had it, that we more or less knew inflation was going to come down, and it's because of I hear regurgitating sound here. I don't know if it's from where you are, but 0.6.
Did you shut the door?
I didn't, but it was happening before. Damn it. So we knew last year, October, there was a 0.6 reading, and we knew that this year was likely going to come in less. Therefore, inflation was going to come down. We didn't realize it was going to come down as much as it did. But the reason we threw this graph up here is that if you look at it, in November, you got a 0.5 reading. So that's the next one that's going to fall off in the December, 14th? What did we say? December 13th. December 13th CPI comes out the day before the Fed meeting. And so if inflation came in like it did this month, inflation is going to continue to drop. So that's going to be a positive. Same thing for December. You got another 0.6 reading. January is a 0.6 reading. And this is just the core consumer price index here. This isn't headline inflation. So Josh, what do you want to talk about here before we move on to the next slide?
Well, it's funny. Simon just piped in with a comment, and it's a comment that I made earlier in the show. It says, this graph tells me it's not changing much. It's just high inflation. So now remember, we're looking back over the last year.
Yeah,
and
that's last year.
The point that Jeb is making is these come in lower. So let's look. Everyone's excited last week. The bond market rallied because we saw 0.3% month over month. reading. So if you had 0.3 for the next 12 months, we'd still have 3.6% inflation, way better than what we have. But 3.6, if you had said that to someone in 2017 who said, oh my God, inflation's out of control. So we need to see it moderate even more. Maybe next week when we're having boozy pumpkin spice lattes, we'll go into that data. Reasons, very strong reasons to believe that is going to happen. And we'll see lots of 0.1 and 0.2 readings going forward as these big numbers are falling off.
Good stuff. This is the chart I was talking about earlier. Target probability for the next Fed meeting in December. This is basically showing at 85% expecting a 50 basis point hike, and almost 15% expecting a 75 basis hike. No one, based on this chart, is expecting a quarter. No one's expecting a full point. Now, Josh, as I mentioned earlier in the video, I don't know if you were listening at that point, basically said that you believe there's a case for a 0.25% hike based on wherever the CPI comes in. Correct?
I would say there's no world in which they do 75 basis points, and that's based off of looking at the data that's going to come in the next 27 days, 28 days, however long it is until they meet again. I don't see any data there that would push them to believe they need to do 75. We had another one of the Fed board members out today saying, hey, they're in favor of 50 basis points. Right. If we have a really low CPI reading the day before this, they will do a 0.25 point. So that could be the surprise. They're definitely going to raise. There's no chance of zero. I would say next to no chance of 75. It's going to be a quarter or a half, and I'd say probably 70% leaning towards a half. But there's a significant chance that we could see only a quarter.
There you go. Money supply. So, Josh, what did you want to talk about here with regards to money supply?
Well, for those of you that show up every week, about 3-4 weeks back, we had one of our regular viewers who's bailed on us and hasn't been here the last couple of weeks. Said you can't just massively increase money supply and not expect to have long-term repercussions in terms of inflation. There's an element of truth to that. So you can see that white line there shows a 40% increase from stimulus in the Fed in M2 money supply. But GDP is actually money supply times the velocity of money. So pull up the next one, Jeb, and let's look at what's happened to velocity of money going over the last, 25 years, going back to 1995. You've seen that trend line. COVID, it dropped even lower and it's trended up a tiny bit, but we are still lower than we historically have been. And no one can figure out how to increase the velocity of money. And to explain velocity of money, it means if I have a 20 in my pocket and Jeb makes baseball gloves and I go give him $20 and buy a baseball glove, and then he wants donuts and he goes across the street and buys $20 of donuts, and then the donut maker needs flour and they run over to the store and buy it, that's the velocity of money. It's just turned over a bunch of times. Money is not turning over as quickly. So we increase the supply of money, but it's sitting, it's not moving fast. So we're not seeing GDP growth. So when we look at it, normally, historically is what I should say, not normally, historically, people said massive increases in money supply will lead to massive inflation. That hasn't necessarily been the direct cause here because it was almost completely offset by the decrease in velocity of money. So we saw in the previous chart, M2 money supply is leveling off and decreasing and normalizing, or has begun that process, and velocity hasn't increased. So I would expect when we look at money supply, it will continue to normalize, and I don't expect velocity to pick up. So these are the things that tell us moving forward, inflation is going to moderate. How long it takes to get back down to the Fed's preferred 2%, I don't know. I don't know if it happens in a year. I don't know if it happens in 3 years, but it's absolutely going to happen.
Good stuff. So percent of properties with recent price reduction. So 43% of homes at the moment are seeing some sort of price reduction. You guys are always talking about, hey, everybody's reducing prices. It's everywhere. It's just crashing. Yeah, 43% are reducing prices. And we're going to talk about this in just a minute, more in just a minute. Median home price, list price has actually declined. The new median list price is down to $374,900 from $422. Again, inventory for homes. Josh and I were kind of talking earlier. If you go back to July of 15, you can kind of see a downward trend here. 18 and 19 kind of threw us out of that trend by popping up a little bit. They're kind of moving sideways, and now you're seeing again. we're still below the highs of 19, even 20 with regards to unsold inventory on the current market. My God, that's loud, Josh.
Sorry, I didn't know it was going to make noise. I didn't mean to
Holy
disrupt
cow.
your figures.
Dude, the
We're-
people on the podcast are going to be pissed. They're going to have this thing in their ear.
Maybe tonight was the show we were drinking. Who knows?
Yeah, exactly. So where I am locally, Orange County, active listing inventory. So you can see starting to teeter down a little bit. We were kind of, we started dropping back in September, and then it kind of leveled out, and now it's starting to tick down a little bit. But you can see where we were in 20 and 2019. We're significantly below those levels. We're above where we were in 2021. And then this one's interesting because this is here in our local market, but it comes from a report that I subscribe to, Reports on Housing. And, it basically shows that when a home is priced correctly, that it's selling at 99% of the list price. And it's selling in as quickly as 9 days. When you have a home that's overpriced and they do a price reduction between 1% and 4%, because that home is overpriced by up to 1% or to 4%, it ends up selling for 97.5% of the most recent price, but 94.7% of the original list price. So it's selling again 5% below because you had to reduce, the price, and it takes 43 days for that to happen. And then when you have a home that you're reducing more than 5%, it ends up selling for about 3.5% less than that, equating to around an 87%, price to the original list price. So, and it takes 58 days. So what this is telling you is if you're selling a home, price it correctly from the start, or at least try to. Otherwise, you're going to end up with less money at the end of the day by continuing to reduce. So hopefully
Jeb,
that's helpful. Yep.
Let me keep that up. Let me play devil's advocate for those of you watching at home. It sounds great to say price it correctly. So you show up in my living room. We're talking about selling my house. How do I know that you know what correct pricing is? What numbers are you going to go through with me? What are you going to tell me? I have some opinions or ideas here, and I want to throw them at you, but I want to hear what you have to say first.
Well, I mean, I'm going to go off recent sales. I'm going to talk about what the market's doing. I'm going to talk about, we're going to try to find what properties in your neighborhood have sold for, in your area have sold for, where they started, where they ended up closing. If I can't get enough information, I might call the agent and say, hey, listen, what kind of activity you got? Why did you start at the price you did? So, and just try to provide a little bit of context behind it. And also, tell the seller, or let the seller, at the end of the day, the seller picks the price. I'm not there to tell the seller, hey, listen, I know it all. My price is the final answer. I'm just trying to give you some guidance on where the market is. So it's really about showing a seller, hey, listen, this is what happens when we don't price it correctly. Homes tend to sit, they end up selling for less money. They take longer to sell, and then using comps in their neighborhood to be able to provide that information in detail to them. But at the end of the day, like I said, we were in a market that was going crazy with prices going up, and people wanted to list their house higher than where I thought it should be listed. And I said, listen, at the end of the day, you pick the price, and those homes ended up selling at where they wanted to sell them, even higher in some cases where I thought it should have been priced lower. So I'm probably a bit more conservative in my estimates, especially in the market that we're in right now, because I don't want to be, caught, with, a home just sitting where I suggested a much higher price. But I also believe that you can't overprice a home. Or underprice a home, rather. So I believe if you price it correctly, maybe even under what that neighborhood has been doing, you're still going to sell it in a relatively quickly time and pretty close to the asking price.
I think this is an awesome tool for a realtor here in Orange County if you had access to similar data in your area, because people just don't want to deal with the fact that it's not 2021 and you can't just look at the last sale and put a higher number out on it. We talked about that house in my neighborhood, Jeb. It's the same square footage, the same floor plan as a home that was completely redone and gorgeous that sold for $1,810,000, something like that. These people list theirs at $1,800,000, and you're like, Do you not know that your house looks nothing like that other house? It's the same floor plan, same square footage, but no similarities other than that. They had a $50,000 price cut and still it sits there. If they had seen data like this from an agent saying, listen, we can price it wherever you want to. What I can tell you is the data is showing us that overpricing the home to start leads to a lower end sale price.
Well, I would play devil's advocate to that, and again, I don't know if bias is the right thing to say, but I would think that most professional agents out there are having that conversation, and sellers are choosing to do what they want to do. Just because that's the nature of the business, right? I mean, after 20 years of selling real estate, sellers think they know more than me all the time. And sometimes they're right. Most of the time, they're not. So can that agent be providing useful information 1,000% and the seller not taking it? Sure. Can it also be the other side where an agent is overpricing a home or telling them it's worth more to get the listing? Sure. I mean, that could also be the case. But I think anybody in this market, if you've been in a market where homes sit on the market for 6 months, a year, and they don't sell, trust me, it sucks. It sucks having those conversations every single week with the seller who's asking, what can I do? You don't want to have those. So I'd rather be on the other side of it and try to make sure we're having that conversation up front so that we're not having those crazy conversations 3 months into this. And we could have just started, at a lower price to start. So hopefully you guys find some value in listening to that. All right, Josh, got a couple more questions here. Kim came in with a question earlier. Says, my school loan has a new lender. Should I start paying them and forget the deferment at this point? So my school loan. Oh, I got you. Never mind. I got you. Okay. Student loan. She has a student loan. It has a new lender. Should she start paying them and forget the deferment? Thoughts?
Everyone has to make a personal decision, but anyone who asked me throughout this CARES Act forbearance, I said, here's the beauty of it. It's not accruing interest. Any money you pay is going towards principal. Pay as much as you can on it now and see if we can make a dent in it. Unless, and here's the caveat, if you are going to be eligible for PSLF, the Public Servant Loan Forgiveness Program, then I understand not making payments. So if you're going to be eligible for forgiveness at some point, then by all means, stretch that thing out as long as you can. And Jeb, this was a really funny coincidence. I do a lot of loans for people with student loans. We were one of the first mortgage people out there talking about the issue and how to qualify and how to get lenders to approve your loan, despite the fact that you have $100,000, $200,000, $300,000 of student loans in an IBR plan, an income-based repayment. Well, I get an email from a borrower this afternoon that they're wanting to write an offer. And he goes, hey, I got good news. They just forgave my student loans. And I'm like, what? And I look at it and I'm like, there's over $100,000 of forgiveness. And I sent him an email and said, congratulations. I go, literally, I talk to hundreds of people a year with big student loans and they tell me they're eligible for PSLF. You are literally the first person that I've ever talked to or seen that has got them forgiven. And about an hour and a half later, I had a call with a past client. They're thinking about doing a HELOC. They wanted to run through the numbers. And she tells me, hey, and just so you know, the good news is going forward, whenever we buy another house or refinance with you, they just forgave my student loan. She had $350,000. She's a lawyer. She had $350,000 of student loans that got forgiven. So she did 10 years working for the state of California to get those forgiven. But you can imagine she was floating around on cloud nine. So that comes into play. And for any of you out there with student loans who are eligible for PSLF, I never want to rain on anyone's parade, but I've always been kind of like, yeah, cool. I hear people are going to be eligible for it. I never see anyone actually getting it. It does appear as though we're now hitting enough people at that 10, 11, 12 year time frame from when they first started, and they put their 10 years in and they're getting their student loans forgiven.
Good stuff. My neighbor actually had his forgiven. He's a teacher. Yeah. I don't know how much it was, but quite a bit. Alex says, loudest ice drop in history. I think I agree 1,000% with that one. Bob says, I'm on a deadline to get a first house. Baby's coming in June. Will there be a noticeable difference of me buying now or waiting till the spring? So Josh, what are your thoughts on that? I mean, here's what I'll say. I heard Dave Ramsey say something recently, and I agree with the statement, but I also don't agree with the statement. And the statement was, why wait and delay buying a house? Why not buy it now? You know what the interest rate is going to be now. And if interest rates go down, you're able to refinance and take advantage of that lower monthly payment. Now, the caveat or the downside to that is you could say, well, what if house prices are less in a couple of months? And what if rates are less in a couple of months? It's going to be a significantly different situation. And so I agree with both of them. But what I will say is that this is time of year when it's less competitive in the market. It's a better opportunity to get in. If you could find the right house now and you're comfortable with the payment now, then I'd say now is the time. Now, if you can't find the right house, or you're thinking, hey, listen, I'm kind of stretching myself, it would be a little bit better if this were happening or whatever, then maybe you wait. But I think it's, again, one of those personal choices. But Josh, what are your thoughts on it?
So what's going to change, or what could change in the next 6 months? We've already gone through interest rates. We think interest rates are going to be lower. I also said I don't think rates are going to drop to the floor. So I think they're going to be back in the 5% range, plus or minus 5%, but that could be 12 months. So is it going to happen in the next 6 months? It could. Not sure it's going to. Home prices can be higher or lower. Don't think there's a whole lot of risk of them being higher. Home price trajectory going forward is largely going to be a story of affordability. As we've talked about, incomes are not going to see a huge increase. Home prices could come down. Interest rates will come down. As long as interest rates come down and moderate to that 5% level or even lower, I think home prices will hold in pretty solidly. So I would kind of defer to what you said, Jeb. Be in the market now, but not with any pressure that you have to do it. If the right property pops up, or if you're making offers now that someone just has to sell in the middle of January when there's not a lot of buyers out there, be in a position to be the person that can negotiate a good deal on that. Being in the market doesn't cost you anything. You don't have to buy just because you're in the market now, but you can miss good opportunities if you wait to start your search.
And what I will say about that is there are some sellers out there that are panicking, that are in a position where they want to sell. So if you can find one of those opportunities, that might be the best of both worlds. I mean, you get in now at a reduced price, and at some point in the future, rates go down, you can refinance. So, but again, like Josh said, no pressure to do anything. Again, buy when it's the right time in your life. Jose says, what can you say about Santa Barbara? Seems like the market's not moving. The only thing I can say about Santa Barbara is that I'm actually going to be there the first weekend of December. My wife and I's anniversary is coming up, and actually we're going to Santa Barbara for the weekend. Outside of that, I've never been to Santa Barbara. Josh, been in California, never been to Santa Barbara ever. So I've been around there, but never to Santa Barbara itself. So that's the only thing I could say. Outside of that, I don't know what the market's doing there. If you need an agent, I can refer you one. I know some great agents in that market, but that's all I got.
So the good news, Jeb, about 15, 20, maybe 30 minutes north of Santa Barbara, there's a Firestone Walker brewery. So you can go get as much 805 and pretzels as you want.
Yeah, I'm thinking, Nikki might not like that. She might just want to drink some wine.
Your wife wouldn't like going to a brewery. Come on. I know your
not
wife
30 minutes away. Not 30 minutes away, bro.
I know your wife's better than that.
She wants to hike. This is like we're going to do yoga. I don't know. I'm just making this up. Let's see. That was pretty funny though, right? I just saw, let's see here. I was just going to click on something. Let's see. Arthur says, how much should one spend on housing? Mortgage, house, bills, taxes, insurance, percentage-wise to what they make net. So earlier in the show, I don't know if you were on, Shaheedah says she likes 30 to 35% of your take home. California, that's really, really conservative. That's going to be very difficult to do unless you make a ton and have a lot of money for a down payment. But Josh, what are your thoughts on that?
Again, the net is really difficult just because it can be manipulated. Some people have 401k funds taken out. Some people have multiple dependents. Some people claim they're exempt. Some people get big refunds at the end of the year. Some people pay taxes at the end of the year. I would defer more to a residual income calculation of saying, okay, you're buying a 2,000 square foot house in this city. This is what utilities should cost. This is the size of your family. There's not really a lot of really good rules of thumb. What I would say is hopefully you've been budgeting and you have a strong sense of what's right and comfortable for you.
There you go. Wesley comes in, says, when will beach parking rates come down in Huntington? I don't know that they will. That's a moneymaker for the city, right? I mean, is all those people parking in parking lots? I mean, your best case, honestly, if you want to know the workaround, is you park at a meter and you pay a lot less. So you get to the beach early, you park in a meter right on the beach, and you fill it every 2 or 3 hours. You can do it now with your credit card, which is great. And it's a hell of a lot less expensive than doing that. And if you live locally, you can actually buy the city pass, which is $150, and you can park in all the lots on the beach from, certain areas and all of downtown, parking for free for an entire year. So if you at the beach a lot, that's the best way to go. But outside of that, man, you're not going to see it. It's a moneymaker without question, especially for all those people that just come down for a couple hours. Maria says, can you sell a home that has a lien or maybe paid it off on sale? So yes, most houses have liens on them. Mortgages are liens on those properties. So that's one. Yes, you can absolutely sell a house that has a lien. But if you're talking like, a mechanic's lien or a tax lien or some sort of lis pendens or something on the property, as long as it can be, you can get the other party to provide a statement at closing of how much that is. It can be paid off during closing, assuming that you have the money there to be able to satisfy it and sell that property. So yes, it can be, but that's part of escrow's job, is to be able to get that information. Title's job as well, but escrow's job to get those payoffs to make sure that can actually happen through the close of escrow.
Yeah, we just talked about it earlier in the show. We have a viewer here that closed. He was supposed to close Monday, and we couldn't close till Wednesday because there was an undisclosed lien that title discovered at the last minute, and they had to track down a payoff demand and get it paid through escrow so the title would issue title insurance, and we were able to fund the loan this morning.
All right. Here's a really good question, Josh. Something that we don't get very often. I know y'all mentioned 2 years ago, I know y'all mentioned 2 years of income history. Does that apply to recent college grads? Josh, how does that work?
It does, but your time in college qualifies as your income history. You were there training for the job. Now, maybe
I was training for a lot of things in college, Josh, and job was at the lower end of that list.
Beer drinking, skirt chasing, all sorts of things Jeb was into.
Oh, boy.
So no, basically, they're going to look at that and say, "Hey, you were in college, you got out, and you have your nursing degree, and you're a nurse. You have your teaching degree, and you're a teacher. You have your Juris Doctorate, and you're a lawyer." So we're looking at that, and they will ask for transcripts to show when you were in school to cover that 2-year history. And on your loan application, you have your current employment, and your prior employment was as a student, and that's how we document it.
Good stuff. Arthur says, thanks for the response, gentlemen. Always watch the show. Appreciate you, Arthur. Clara says, when is the real estate market going to crash? I believe it's, what do we say, Josh? October 27th, 2029. 2029 is when it's going to crash in October. Get ready. You got plenty of time. You're good.
So here's a good one. If you want to research it, there's a book that unfortunately is not available on Kindle, but you can buy it off of Amazon, The Secret History of Real Estate. And the guy has some very well-researched data going back like 300 years that he says it's going to be 2027. Interesting book, whether you agree with him or not.
All right, there you go. And another interesting book about the Fed. Have you ever read the Creature of Jekyll Island? Have you ever read that, Josh? Oh, no, I have to bring it in for you. Very dense book, but, a little bit of conspiracy around the Fed and why it was created and all of this. Good info. Anyway, The Creature of Jekyll Island, that's what it's called. Anyway, let's see. Josh, we talked about this earlier too. What are your thoughts on the current yield curve inversion? So what are your thoughts?
The most obvious one is that the market is telling you that they expect rates to be lower in the future. That's why they're charging more in the short run. They believe inflation is transitory, even though they laugh at everyone who said transitory last year. But you look at 2 years out to 5 years is higher than 7 to 30 years. Tells you that they don't believe that inflation is going to remain elevated. And in the next 12 months or so, we're going to find out what the market thinks normal is, because we came off of a period of abnormally low rates. So a 10-year treasury in the 1 to 2% range, that's probably not normal. Is the new normal 3%? Is it 2.5%? Is it 3.5%? We're at 3.7, 3.79, just about 3.8 as of today on the 10-year, and fully expect that to normalize down to 3%, if not possibly a little bit lower. The question is just when. And to me, that's what the yield curve is telling us. And it's also telling us that the economy is slowing and we're likely headed to a recession if we're not there already.
All right, there you go. JK kind of made it just a statement that I think a lot of people are probably seeing out there as well. Also, lots of homes descriptions on Redfin Zillow saying the seller will pay closing costs and or buy down the rate. Sign of the times. It's a sign of the times. Buy downs have always been available. Seller paid closing costs have always been around. The last couple of years, nobody was doing it. No one was offering it because, quite frankly, you didn't have to. So as things continue, Josh just said normalize. As things continue to normalize, you're going to see more normal things like this happen in the market. So no surprises there. Josh, we are... let's see here. We'll answer this question real quick. Clara says, my goal is to purchase land and build a house. I live in Cali. How can I get approved for a hard money loan for my goal? What's my steps? So Josh, a lot going on in that question, but I think the easy answer is how much money do you need to get a hard money loan? I mean, how much money do you have to put down to be able to make that happen?
We'll get Brent on as a guest and have him walk us through this.
That would be hilarious, by the way.
He said he's going to tune in and laugh at us and ask mean questions. So hopefully he'll do that. He might be posing as Graham. But anyways, so 30
He's smarter
to 40,
than that.
a lot. 30 to 40% down would be what you're looking at generally for a hard money loan. But my question is, why are we talking about a hard money loan? Why not a standard construction loan? If we have a credit situation or an income situation that's pushing you towards hard money, we probably should work on that before we work on the goal of acquiring the land and getting a home. And hopefully you're in a part of California that's not densely populated like Southern California or the Bay Area, where it's realistic to find land at a reasonable price. I know it does exist, especially north of the Bay Area where no Californians live, but the Central Valley, that type of stuff, you can do it. It's just important to see where you're looking.
Yeah, and I agree with your statement there, Alex. It's just an interesting read nonetheless, the whole idea behind it. So anyway, so we have been on tonight for almost 2 hours. David said he's just tuning in. David, you missed a lot of what happened in the first 5 minutes of the show. It's worth of watching. Quite frankly, I'm in Josh's seat. Josh is in an office. He got booted entirely from his own seat.
David's like, what the hell happened? I showed up late and everyone's in weird places.
Yeah, we figured out that you can't actually run the show on one camera sitting side by side, that you actually need two cameras. So it looks like we're going to have to buy 2 new computers, 2 new cameras in order to make this happen, Josh. Money is going out the window as we speak. But if you're just tuning in now, go back, watch the show, check it out. Let us know what you thought. A lot of good information tonight. It'll be streamed on the podcast on Friday, which is up in the corner there. Take a listen to it. This past Tuesday, we talked about credit in detail. Previous week, we talked about red flags when getting a loan. Also something that you want to check out if you're in the process to buy a home. So go check that out. And if you find any value, refer it to a friend, like it, subscribe it, leave a review, all of that good stuff. And I ask that you do the same thing here on YouTube. If you find any value, hit the like. There's 171 people watching at the moment and 87 thumbs up. So that means some of y'all are slacking at the moment, and we would appreciate you stepping up and doing that for us being here. So Josh, what do you want to add?
I think we overachieved with 87 thumbs up with the way we started this show. I think that's a pretty good recovery. That's a pretty good recovery.
That's fair. That's a testament to people wanting to see us and be here because we're so entertaining. But we'll be back next Wednesday. Yes, it's the day before Thanksgiving, but y'all don't have to work, so you should be here. We'll chat in more detail. Maybe drink a little bit. I don't know, eat some pie. I don't know what we're gonna do. Who knows? Stay tuned as we show up. All right, guys. Until then.